Hi, my name's Joe Knight, and for a living I teach people about finance. My partner, Karen Berman, and co-author of our best-selling book, Financial Intelligence, wanted me to redo a YouTube that we recently did on the financial crisis and financial bailout. As I travel around the world teaching finance, I get a lot of questions such as, what makes a bank fail? What are mortgage-backed securities? Who are Freddie Mac and Fannie Mae? What is a subprime loan? How did it all happen? And in a subsequent exciting sequel to this YouTube, we're going to talk about who's to blame. To better understand this, let's talk about how a bank makes money. First of all, banks have assets, or what they own. As you can see here, what banks own and savings and loans own are loans or mortgages and cash. Now, where do they get their cash? From deposits and from borrowings from other banks. What a savings loan does is takes that cash, loans it out to people, and has an income from those loans. Now, in the 80s, most of these savings and loans had their loans tied up in 30-year mortgages at 3 to 5%. Unfortunately, their deposits were requiring higher interest rates during that time because the prevailing inflation rate was over 10%. So clearly you can see here in this little chart that if your assets are paying you 3 to 5%, but your liabilities are costing you 10%, at some point your worth is going to go negative. This is a simple balance sheet. And when a bank's balance sheet goes negative, in other words, they have more liabilities than assets, they're insolvent or bankrupt. With the savings and loans insolvent and our mortgage system broken down, the government decided they needed to step in and bail out these savings and loans. And one of the tools they used to do that was two government-sponsored entities, Freddie Mac and Fannie Mae. Now, what I've done is I've gone to a thrift store last night, and to make this presentation more professional, I have bought some props that we can use. So, here's Freddie and Fannie. Freddie and Fannie came to the rescue by purchasing these mortgages at low interest rates from these savings and loans, thus making them solvent, giving them cash so they could make loans again. This got our financial system back and running. Now, with Freddie and Fannie holding all these mortgages, they needed to do something to get solvent themselves. And what they did is they pooled their mortgages together into a mortgage pool. The mortgages were pulled together and sold to investors on Wall Street. These investors on Wall Street pooled these mortgages and sold them as bonds to investors. This is what we call a mortgage-backed security. Now let's talk a little bit about mortgage-backed securities and how they grew and expanded in our American markets. First of all, Freddie and Fannie were commissioned to buy a certain kind of mortgage called a prime mortgage. Let's talk about what a prime mortgage is. Mr. and Mrs. Mouse want to buy a home. Mr. and Mrs. Mouse have a good credit rating. Now they shop for a home and they find a nice home within their means. This home is affordable for Mr. and Mrs. Mouse based on their income. A prime mortgage for Mr. and Mrs. Mouse would be a 30-year fixed rate mortgage well within their capability to pay. These were the types of mortgages that Freddie and Fannie were buying and pooling together and selling. Now, let's just change the circumstances. Mr. and Mrs. Mouse get with a mortgage broker who convinces them with a variable rate loan they can get a bigger house. Now look at what Mr. and Mrs. Mouse can buy. Look at that. What a beautiful large home. Well, this loan, unfortunately, is a subprime loan. And it's a problem for the banks. The reason why it's a problem for the bank is because this subprime loan cannot be sold to Freddie and Fannie because they buy prime mortgages. Well, during the 90s, there was a new kind of mortgage-backed security offered by people other than Freddie and Fannie. These were subprime mortgage-backed securities. And once again, they were pooled together. There's our mortgage pool. And sold to the Wall Street people. These mortgages paid a higher interest rate, but were a little more risky. A subprime loan is a loan that has three different things that could be happening. First, the borrower could have a low credit rating or not have the capacity to pay for the loan. Two, a subprime loan could be just a certain size. Loans that are too big don't qualify as prime. And then three, a subprime loan can have a variable interest rate, not a fixed rate. Now that we have a market for subprime mortgages in the mortgage-backed security market and the prime, that opened the door for mortgage brokers and banks to start loaning subprime loans and selling them very quickly into this other market. This market was further expanded by our friends at Senate and Congress. Our friends at Senate and Congress passed legislation that forced Freddie and Fannie to start purchasing subprime mortgages as well and pooling them. And of course, They also passed legislation that asked our banks to start doing more subprime lending. What was the effect of opening up our subprime market to these new lenders? Well, this made a lot more demand for housing. That drove up housing prices. And as housing prices went up, this market became stronger and stronger. And of course, these mortgage-backed securities were considered by our friends on Wall Street to be very safe. And so the rating agencies rated these mortgages very high, and they were sold. In fact, there was a point in time when mortgage-backed securities exceeded Treasury bills in volume during 2000 and beyond. This is when the mortgage-backed security was a very popular investment. And everything was running fine as long as housing prices stayed strong and these subprime lenders could refinance. The system was working great. Now that subprime mortgages could be turned into mortgage-backed securities, that questionable subprime borrower could get a loan, and then, of course, the banks could flip the loan when they got that loan. Unfortunately, the mortgage brokers and the bankers that were making these loans were able to flip them and not deal with the consequences when these loans defaulted. Now, our friends on Wall Street didn't mind because they could easily sell these mortgages and package them together. The only risk was when these loans defaulted. But as long as housing prices were increasing, the houses could support the loans themselves, and so there was very little risk for anyone in the system. And the rating agencies rated these types of bonds very high. Then in 2006, something happened. The housing market went flat. And as these subprime mortgages had increasing interest rates and more risk attached to them, the defaults no longer could be supported by the value of the home assets that were supporting them. Therefore, the value of these mortgage-backed securities started dropping very rapidly, and the risk made them a very risky investment, whereas before they were perceived as being very safe. Now, with the drop in the market for mortgage-backed securities, Wall Street stopped purchasing mortgages in the pools. Of course, that created a problem for our friends at Freddie and Fannie and others, because they could no longer sell the mortgages that they had purchased from the banks. Without liquidity at Freddie and Fannie, the banks themselves were left holding many mortgages that they could no longer sell, so they were in a liquidity crisis as well. This clogged up the whole system, and all of a sudden it was very difficult to get a mortgage and to make a mortgage. Consequently, housing prices started to drop because there were less buyers available in this crisis of liquidity. Furthermore, there was another problem that caused these banks to go into bankruptcy very quickly. Now, with all these bank failures happening, there was an accounting rule called mark-to-market accounting that you might have heard of that further exacerbated the crisis. Mark-to-market accounting is an accounting rule that says that if you own assets that have a ready market, you need to mark the value of those assets or what you own to the current market price. Well, unfortunately for these banks that had mortgages they could no longer sell, the mark-to-market value of what they owned, mortgages, started dropping as Wall Street stopped buying these mortgage-backed securities. So, as banks lowered their market value of what they owned, and of course as their deposits and borrowing stayed constant, their worth went negative. And of course we know that when a bank has negative worth, they're bankrupt and can no longer do business. The consequences of being insolvent as a bank is you can no longer borrow from other banks or from the government. So their ability to get cash was wiped out. That created this crisis that you're hearing about today, where there were emergency failures and also emergency mergers of these banks that had wiped out all of their worth through the mark-to-market accounting rule. Now the question on the table is, will the $700 billion government bailout work? And the jury's still out on that. There's a lot of moving parts here. Every day the market is up 200 or down 200. It seems like the volatility will never end. The bailout will help in getting liquidity into our financial systems. Certainly as the government starts buying these mortgages and putting more equity into these banks will be back in business and the mortgage market will open up again. Home buyers will be back out there, and at lower home prices now, there hopefully will be more buyers. And as our housing market starts to stabilize through this liquidity, I would expect that our financial markets will stabilize, as will what's happening on Wall Street. So my feeling is that the bailout will clean up this problem, but it's going to take some time. So that's how this all happened and a little bit about the bailout. If you'd like to learn more about who's to blame, please see my exciting sequel. The thing that I want you to always remember is that every day is a great day to learn about finance.
Setpoint is the leader in turnkey, lean automated equipment. Following the Toyota production system, Setpoint has created custom solutions for a broad variety of industries for over 16 years.